In the year 2000, 1 ounce of gold cost about $270. Today, it trades above $3,300. That's a roughly 12x return over 25 years. Impressive, right? Now consider this. Bitcoin launched in 2009 at essentially zero. Today, a single Bitcoin is worth over $109,000. If you had bought just $100 worth in 2010, you would be sitting on hundreds of millions of dollars right now.
So the question everyone keeps asking is simple. Which one should you actually put your money into right now, in 2026? Gold, the asset that has stored value for 5,000 years, or Bitcoin, the digital upstart that's barely 15 years old but has outperformed everything in financial history? The answer is not as obvious as you think, and by the end of this video, you'll understand exactly why.
Welcome back to the channel. Whether you're a complete beginner just starting to think about investing, or someone who's been in the markets for a while trying to figure out where to allocate capital in this wild economic environment, this video is for you. Here's why this topic matters right now. We are living through one of the most unusual economic periods in modern history. Inflation, while cooling from its 2022 highs, is still stubbornly above the targets that central banks want. The U.S. national debt has blown past $36.8 trillion. Geopolitical tensions are reshaping global trade, and both gold and Bitcoin have been hitting all-time highs in 2025. So in this video, we're going to do a deep, honest, no-hype comparison. I'm going to walk you through the history of both assets, how each one actually works as a store of value, real-world case studies of how they've performed, the risks and controversies you need to know about, and finally, where experts think each one is headed for the rest of 2025 and beyond. No shilling, no bias, just facts and frameworks, so you can make a smarter decision. Before we dive in, if you find this kind of deep dive analysis valuable, do me a quick favor. Hit that subscribe button and tap the bell icon. Only about 30% of the people who watch these videos are actually subscribed, and it genuinely helps the channel keep producing free content like this. All right, let's get into it.
To understand where we are today, we need to understand where these two assets came from. And trust me, this history lesson is anything but boring, because it reveals something fundamental about why humans value what they value. Let's start with gold. Gold has been recognized as valuable for at least 5,000 years. Ancient Egyptians were mining it around 3000 BC. The Lydians, an ancient civilization in what is now Turkey, created the first standardized gold coins around 600 BC. From that point forward, gold became the universal form of money. For millennia, gold was money, not a representation of money, actual money. Empires rose and fell based on how much gold they controlled. The Roman Empire, the Spanish Empire, the British Empire, all of them were powered in large part by gold. Fast forward to the modern era. In 1944, the Bretton Woods Agreement pegged the US dollar and, by extension, most global currencies to gold at $35 per ounce. The dollar was literally defined as a specific weight of gold. This was the gold standard. Then, in 1971, President Richard Nixon did something that changed the global financial system forever. He ended the dollar's convertibility to gold. This moment, known as the Nixon shock, effectively killed the gold standard. From that day forward, the US dollar and every other major currency became what economists call fiat currency. Fiat means by decree. In other words, the dollar has value because the government says it does, not because it's backed by a physical commodity. And here's the critical point most people miss. Since 1971, the purchasing power of the US dollar has declined by over 87%. A dollar today buys roughly what 13 cents bought in 1971. Meanwhile, gold has gone from $35 an ounce to over $3,300. Gold didn't become more valuable, the dollar became less valuable. Gold simply held its purchasing power while the currency eroded around it.
Now let's talk about Bitcoin. Compared to gold's 5,000-year history, Bitcoin is a newborn. It was created in 2008 during the last great financial crisis by a mysterious person or group using the pseudonym Satoshi Nakamoto. In January 2009, Satoshi mined the first Bitcoin block, known as the Genesis block. Embedded in that block was a message: The Times, 03 Jan 2009, Chancellor on brink of second bailout for banks. That wasn't random, it was a statement. Bitcoin was born as a direct response to the failures of the traditional banking system, a system that had just been bailed out with trillions of dollars of taxpayer money, while ordinary people lost their homes, their savings, and their retirement accounts. In its earliest days, Bitcoin was essentially worthless. The first known commercial transaction happened in May 2010 when a programmer named Laszlo Hanyecz paid 10,000 Bitcoin for 2 pizzas. At today's prices, those pizzas would be worth over $1 billion. From there, Bitcoin's trajectory has been nothing short of extraordinary. It went from less than a penny to over $100 by 2013. It crossed $1,000 later that year, it hit nearly $20,000 in late 2017, crashed, recovered, and then exploded to over $69,000 in November 2021. After another crash and a brutal bear market in 2022, Bitcoin surged past $100,000 in late 2024, fueled by the approval of spot Bitcoin ETFs in the United States. And as of July 2025, it trades above $109,000. But here's where it gets interesting. Both gold and Bitcoin are having record-breaking years in 2025. Gold has surged past $3,300 per ounce, and Bitcoin has pushed past $109,000. For the first time in history, both of these safe haven assets are hitting all-time highs at the same time. And that tells us something profound about the current state of the global economy. So now that you know the history, let's break down how each of these assets actually works, because understanding the mechanics is essential to understanding the investment case.
All right, let's strip away the hype and the headlines and look at the actual mechanics of each asset. Because when you understand how something works, you can start to evaluate whether it deserves a place in your portfolio. Let's start with gold. Gold is a chemical element, atomic number 79. It exists in the physical world. You can hold it, you can melt it, you can shape it, and it has several unique physical properties that make it ideal as a store of value. First, gold doesn't corrode, tarnish, or rust. A gold coin buried 2,000 years ago will look essentially the same when you dig it up. Second, gold is scarce. All the gold ever mined in human history would fit into roughly 3.5 Olympic swimming pools. That's it for the entire planet. Third, gold is divisible. You can split it into smaller pieces without losing value. And fourth, it's universally recognized. Walk into any country on Earth with a gold bar and people will recognize its value. The supply of gold grows by about 1 to 1.5% per year through mining. Nobody can suddenly double the supply of gold. It's physically constrained by geology in the difficulty of extraction. This predictable, low rate of new supply is a key reason gold holds its value over time.
Now here's how you invest in gold. You can buy physical gold, coins, bars, jewelry. You can buy gold ETFs, which are exchange-traded funds that hold physical gold in vaults on your behalf. You can buy shares in gold mining companies, or you can trade gold futures and options. Each method has different trade-offs in terms of security, liquidity, fees, and counterparty risk. Now let's look at Bitcoin. Bitcoin is a digital asset that runs on a decentralized network called a blockchain. Think of a blockchain as a digital ledger, like a giant spreadsheet that is shared across thousands of computers around the world. Every Bitcoin transaction ever made is recorded on this ledger, and no single person, company, or government controls it. Bitcoin has a fixed maximum supply of 21 million coins. That number is hard-coded into the protocol and cannot be changed. As of mid-2025, about 19.8 million Bitcoin have already been mined, leaving only about 1.2 million left to be created. And the rate of new Bitcoin creation gets cut in half roughly every 4 years in an event called the halving.
The most recent halving happened in April 2024, reducing the mining reward from 6.25 Bitcoin per block to 3.125. This means the annual inflation rate of Bitcoin's supply is now below 1%, which is actually lower than gold's. Let me say that again. Bitcoin now has a lower inflation rate than gold. And this is where the digital gold narrative comes from. Bitcoin shares several key properties with gold. It's scarce, it's durable in a digital sense, it's divisible down to a 100 millionth of a coin called a Satoshi, and it's increasingly recognized globally as a store of value. But Bitcoin also has properties that gold does not have. You can send $1 billion worth of Bitcoin to anyone, anywhere in the world in about 10 minutes for a few dollars in fees. Try doing that with $1 billion in gold bars. You'd need armored trucks, security teams, shipping containers, insurance, customs clearance. It could take weeks and cost hundreds of thousands of dollars. Bitcoin is also self-custodial. You can hold your own Bitcoin with no intermediary, no bank, no vault, no broker. Your wealth exists as a cryptographic key that you can memorize, store on a hardware device the size of a USB stick, or even engrave on a piece of steel. Most people don't realize this, but this property alone, the ability to carry unlimited wealth across borders in your head, is revolutionary for the billions of people living under authoritarian regimes, capital controls, or hyperinflationary currencies. Now, I'm not saying one is better than the other. Each has strengths and weaknesses, and we're going to get into those. But understanding the mechanics is crucial. Gold's value comes from physical scarcity and 5,000 years of human consensus. Bitcoin's value comes from mathematical scarcity and a rapidly growing global consensus. Both are betting against the same thing, the long-term devaluation of government-issued money. And that brings us to the real-world evidence. How have these two assets actually performed when put to the test? Okay, enough theory. Let's talk about what actually happens when real people and real institutions put real money into these assets, because the performance data might surprise you. Let's start with raw returns. Over the last 10 years, from mid-2015 to mid-2025, gold has returned approximately 145%. That means if you invested $10,000 in gold in 2015, you'd have roughly $24,500 today. Not bad at all. Bitcoin, over the same period, it has returned over 43,000%. That same $10,000 invested in Bitcoin in mid-2015 would be worth over $4.3 million today. Now, before you say, well, that settles it, Bitcoin wins, stay with me. because this next part changes everything. Returns are only half the story. The other half is volatility, how much the price swings up and down along the way. Gold is known for its stability. In a bad year, gold might drop 10 to 15%. In the 2008 financial crisis, gold initially dipped about 25% before recovering and eventually doubling. Its worst calendar year drawdown in recent decades was around 28% in 2013. Bitcoin, on the other hand, is a roller coaster. It has experienced drawdowns of over 80%, not once, but multiple times. In 2014, it dropped about 85% from its peak. In 2018, it fell 84%. In 2022, it crashed from nearly 69,000 to under 16,000, a 77% drop. Think about that psychologically. Imagine watching your $100,000 investment shrink to $15,000. Most people can't stomach that, and many don't. They panic sell at the bottom and lock in devastating losses. So here's the key insight. Bitcoin's returns have been astronomically higher, but the ride has been brutal. Gold offers far more stability but significantly lower returns. The question is really about your time horizon, your risk tolerance, and your conviction. Now, let's look at some real-world case studies of how these assets perform in different environments. Case Study 1, the inflation hedge test. From 2020 to 2023, the world experienced the highest inflation in 40 years. The U.S. Consumer Price Index peaked at 9.1% in June 2022. How did our two assets respond? Gold performed as expected. It rose steadily, peaking at just over $2,070 per ounce in mid-2023, before exploding higher in 2024 and 2025. It did its job as an inflation hedge. Bitcoin's response was more complicated. Initially, Bitcoin surged alongside inflation in 2020 and 2021, running from under 10,000 to over 69,000. But when the Federal Reserve started aggressively raising interest rates to combat inflation in 2022, Bitcoin crashed hard. It behaved more like a risky tech stock than a safe haven. However, and this is important, Bitcoin recovered everything it lost and then some, surging past $100,000 by late 2024. For patient long-term holders, Bitcoin still massively outperformed gold even through the inflation cycle. For short-term traders, it was a disaster. Case Study 2, Geopolitical Crises. When Russia invaded Ukraine in February 2022, gold spiked immediately, jumping from about $1,800 to over $2,050 per ounce within 2 weeks. Classic flight-to-safety behavior. Bitcoin initially dropped from around $38,000 to around $34,000 before recovering. It did not behave as a safe haven in that moment. But interestingly, Bitcoin donations poured into Ukraine. The Ukrainian government raised over $100 million in crypto donations within weeks, because Bitcoin and other cryptocurrencies could be sent instantly across borders without banks or intermediary approval. This highlighted a unique use case for Bitcoin that gold simply cannot replicate. Permissionless, borderless, instant transfer of value during a crisis. Case Study 3, Institutional Adoption. In January 2024, the U.S. Securities and Exchange Commission approved 11 spot Bitcoin ETFs. This was a watershed moment. Within the first year, these ETFs attracted over $65 billion in net inflows, making the iShares Bitcoin Trust, ticker IBIT, the fastest-growing ETF in history. To put this in perspective, when the first gold ETFs launched in 2004, it took years to accumulate that level of assets. Bitcoin ETFs did it in months. Meanwhile, gold ETFs have seen modest net outflows or flat flows in many recent quarters, as investors rotated some allocation into Bitcoin. Central banks, however, are buying gold at a record pace. In 2023 and 2024, central banks collectively purchased over 1,000 tons of gold each year, the highest levels in decades. China, India, Poland, Turkey,
and many other nations are actively increasing their gold reserves as they seek to diversify away from the US dollar. So here's the fascinating dynamic. Retail investors and tech-forward institutions are flooding into Bitcoin. Central banks and sovereign wealth funds are flooding into gold. Both groups are responding to the same fear, the devaluation of fiat currencies, but choosing different solutions. This brings us to the part of the video where we need to get brutally honest about what could go wrong with each of these investments.
Every investment has risks. Anyone who tells you otherwise is either uninformed or trying to sell you something. So let's go through the biggest risks for both gold and Bitcoin, starting with gold. Gold risk number 1, opportunity cost. Gold doesn't produce income, it doesn't pay dividends, it doesn't generate cash flow. A bar of gold sitting in a vault today will be the same bar of gold in 50 years. It won't grow, expand, or innovate. Warren Buffett famously criticized gold for this reason, saying that all the gold in the world could be melted into a cube about 68 feet on each side, and for the same price, you could buy all the farmland in the United States, plus 16 ExxonMobils, and still have $1 trillion in walking around money. Gold risk number 2, storage and security costs. Physical gold needs to be stored somewhere secure, a safe, a bank vault, a depository. This costs money. You also need insurance, and if you hold gold at home, you bear the risk of theft. Gold risk number 3, limited upside. Gold's long-term average annual return is roughly 7 to 8%. That keeps pace with inflation, but barely. In a world of increasing innovation and productivity growth, simply keeping pace with inflation means you're running on a treadmill. Gold risk number 4, counterfeiting and purity concerns. Not all gold is real. Counterfeit gold bars, sometimes filled with tungsten, which has a similar density, have been discovered in vaults around the world. Verification requires specialized equipment.
Now, let's look at Bitcoin's risks, and I'll be equally candid. Bitcoin risk number 1, extreme volatility. We already covered this, but it bears repeating. Bitcoin can lose 30, 40, even 50% of its value in a matter of weeks. The 2022 crash wiped out over $2 trillion in total crypto market value. If you need your money within a 1 to 3 year window, this volatility can be devastating. Bitcoin risk number 2, regulatory uncertainty. Governments around the world are still figuring out how to regulate Bitcoin. While the US has become more crypto-friendly under the current administration, with President Trump signing an executive order in 2025 to establish a strategic Bitcoin reserve, other countries have been less welcoming. China banned crypto trading and mining, India has imposed steep taxes, and any major economy could implement unfavorable regulations at any time. Bitcoin risk number 3, technology risk. Bitcoin's blockchain has been remarkably secure for 15 years, but it's not immune to theoretical threats. The most discussed is the quantum computing threat, the idea that future quantum computers could potentially break the cryptographic algorithms that secure Bitcoin. Most experts say this is at least 10 to 20 years away, and Bitcoin's protocol could be updated to resist quantum attacks, but it remains a risk worth monitoring. Bitcoin risk number 4, self-custody risk. If you hold your own Bitcoin and lose your private keys, the digital passwords that control your coins, your Bitcoin is gone forever. There is no customer service number to call, no reset button. It's estimated that between 3 and 4 million Bitcoin are permanently lost due to forgotten passwords, lost hard drives, and deceased holders who didn't leave instructions.
That's roughly 17 to 20% of all Bitcoin ever mined. Bitcoin risk number 5, environmental criticism. Bitcoin mining consumes significant amounts of electricity.
The network uses approximately 120 to 150 terawatt-hours of electricity per year, comparable to the energy consumption of a mid-sized country like Argentina or Norway. Critics argue this is wasteful. Proponents counter that much of this mining uses renewable or stranded energy, and that the energy cost is justified by the security of a global, decentralized monetary network. And one more risk for both assets, but especially Bitcoin. Narratives change. Gold has survived 5,000 years of shifting narratives. Bitcoin has only been tested for 15. If the digital gold narrative ever breaks, if a critical flaw is found, or if a superior technology emerges, Bitcoin could lose its premium rapidly. Gold doesn't have that risk because its value isn't based on code. But here's the counter-argument. The internet has also only existed for about 30 years, and nobody's betting against it. Sometimes new technology doesn't need thousands of years of history. Sometimes it just needs to be fundamentally better. Okay, we've covered the history, the mechanics, the real-world performance, and the risks. Now it's time for the part everyone's been waiting for. Where are these assets heading next?
Predicting the future is a fool's errand. So instead of making predictions, let me lay out the key factors and scenarios that will shape the trajectory of both assets. Then you can decide what makes sense for your situation. Factors favoring gold in 2025 and beyond. Number 1, central bank buying shows no signs of slowing. The de-dollarization trend, where countries seek to reduce their dependence on the US dollar, is accelerating. As long as geopolitical tensions persist and trust in the dollar erodes, central banks will keep buying gold. Number 2, gold benefits from a rate-cutting cycle. When interest rates fall, the opportunity cost of holding gold decreases because you're giving up less yield by holding a non-income producing asset. As of mid-2025, the Federal Reserve is expected to begin cutting rates in the second half of the year, which could be a tailwind for gold. Number 3, gold has no technology risk, no regulatory risk, and near universal acceptance. It's the ultimate sleep-well-at-night asset. Several major banks and analysts have price targets for gold between $3,500 and $4,000 per ounce by end of 2025, with some long-term projections exceeding $5,000. Now, factors favoring Bitcoin. Number 1, the April 2024 halving has reduced new supply to historic lows. Historically, the 12 to 18 months following each halving have produced Bitcoin's most explosive price appreciation. We are currently in that window. Number 2, institutional infrastructure is now in place. The spot Bitcoin ETFs have created a massive on-ramp for traditional investors, pension funds, endowments, and wealth managers who previously couldn't or wouldn't touch Bitcoin. The total assets in Bitcoin ETFs have surpassed gold ETF assets in the US for the first time in early 2025. Number 3, sovereign adoption is accelerating. The United States, under President Trump's executive order, has established a strategic Bitcoin reserve. El Salvador, which adopted Bitcoin as legal tender in 2021, has seen its holdings appreciate significantly. Other nations are exploring similar moves. Number 4, Bitcoin's network effect continues to compound. More users, more developers, more applications, more institutional support, each reinforcing the others in a virtuous cycle. Well-known analysts and figures in the space have a wide range of predictions. Cathie Wood's ARK Invest has a 2030 bull case target of $1.5 million per Bitcoin. Standard Chartered has projected $200,000 by end of 2025. Even more conservative analysts suggest Bitcoin could reach $150,000 to $200,000 in the current cycle. But here's the nuanced take that most YouTube videos won't give you. It's not necessarily an either-or choice. Many sophisticated investors, Ray Dalio, Larry Fink, BlackRock, and others, have argued for holding both gold and Bitcoin as complementary assets. Gold for stability, deep liquidity, and proven track record. Bitcoin for asymmetric upside, portability, and innovation exposure. A common allocation framework gaining traction is what some call the bell-bell approach, heavy allocation to ultra-stable assets on one end, including gold, and a smaller but meaningful allocation to high upside assets like Bitcoin on the other end.
Some advisors suggest a 5 to 15% allocation to Bitcoin alongside a 10 to 20% allocation to gold, depending on age, risk tolerance, and financial goals. The question isn't really Bitcoin or gold. The question is how much of each given your personal situation, and that's a question only you can answer.
All right, let's bring this all together. Here are the key takeaways from everything we've covered. Takeaway 1. Gold is the ultimate proven store of value. 5,000 years of history, universal recognition, central bank backing, and unmatched stability. If you want to preserve wealth with minimal stress, gold has an unassailable track record. Takeaway 2. Bitcoin is the highest performing asset of the last 15 years and is increasingly being adopted by institutions and governments. Its fixed supply, digital portability, and growing network effects give it asymmetric upside potential, but it comes with significant volatility and risk. Takeaway 3. Both assets are responding to the same macro trend, the devaluation of fiat currencies through money printing, deficit spending, and monetary expansion. As long as governments continue to debase their currencies, both gold and Bitcoin are likely to appreciate. Takeaway 4. It's not necessarily a binary choice. A thoughtful portfolio may include both, in proportions that match your risk tolerance, time horizon, and financial goals. Here's my honest assessment. If I had to pick one asset to hold for the next 50 years and couldn't touch it, I'd want to own both, but the ratio would depend on my age and risk tolerance. If I were 25, I'd lean heavily toward Bitcoin. If I were 60, I'd lean heavily toward gold. And at any age, I'd want at least some exposure to both. But that's not financial advice. That's a framework for thinking. Everyone's situation is different, and you should always do your own research and consult with a qualified financial professional before making investment decisions.
And that's a wrap on Bitcoin versus gold in 2025. This is one of the most important investment debates of our generation, and I hope this video gave you a clearer framework for thinking about it. Now, I want to hear from you. Drop a comment below and tell me, if you could only invest in one of these assets for the next 10 years, which would you choose, Bitcoin or gold, and why? I read every comment and I'm genuinely curious what you think. If you found this analysis valuable, smash that like button. It really helps the algorithm push this video to more people who need to see it. And if you haven't subscribed yet, now is the time. We put out deep dive content like this every week, covering crypto, investing, and the future of money. Check out this video right here for our deep dive on the Bitcoin halving and what it means for the 2025 bull market. I'll see you in the next one.